So in the end, what we see is a result that I don't think I expected, and you probably didn't either. What's up, you guys? Welcome back to the Average Joe Investor channel. A couple of weeks ago, I received a comment on a YouTube video asking why I was interested at all in investing in the small cap or the Russell 2000 because interest rates aren't low right now. The real point he was trying to communicate to me was there's no point in investing in the Russell 2000 or any small cap stocks or a small cap ETF because they require low interest rates to grow. Now, fundamentally, that makes sense on some level, right? Because a lot of small companies, in order to grow significantly, need to finance that growth, at least in the beginning. But I wanted to make sure I could test that data. So, of course, I built a spreadsheet. In this video, we're going to take a look at the historical federal funds rate compared to the markets, not only the small cap, but also the S&P 500 and the NASDAQ 100 to see what type of correlation exists between these indexes and the federal funds rate. Do small cap stocks and small cap ETFs need a low interest rate environment to grow? And depending on where we are at with interest rate policy, which index is the best one to invest in? I never want to waste your time, and I always want to deliver massive value. So without further delay, let's dive in. Okay, so we've got a few different tabs we're going to look at here. First is we're going to look at small cap ETFs compared to historical interest rates. And what I utilized for interest rates was the Federal Reserve's federal funds rate. Going back, which technically I could go back all the way to 1954, but reality, we're going to go back to the year 2000 right here, which is when we have historical data going back for IWM. The data for the federal funds rate was taken from the stlouisfed.org website, and all of the historical price data for the Russell 2000, pictured right here, and the small cap S&P 600 right here were pulled from stockanalysis.com. Here's what we're looking at right now. We've got small cap ETFs, both the Russell 2000 in blue and the S&P 600 in green, and then we've also got the federal funds rate during this time, which is in orange. And what we notice is going back to June of 2000 all the way through the present time, this is the price per share of the ETF, and then over here we've got the actual federal funds rate. Okay, so the orange line is tied to this index, this graph right, this axis right here, and the blue and the green lines are tied to this one over here on the left. So what we notice is that we have a drop in interest rates here going into 2001 to 2004. We have relatively low interest rates right here, and markets kind of grow a little bit more growth with the Russell 2000 than the S&P 600. Then what we see is a spike in interest rates from about 1.03% to a high of 5.25% in 2006. And during this time frame, we see growth in the small cap from here to here. The small cap grew from 23.18 to a high of about 35, whereas the Russell 2000 grew from about 54 up to a high of 82.96. So we're talking about rising interest rates, but both of the small cap ETFs continued to grow. Okay, then we have a massive drop in interest rates from here, which dropped from 5 all the way down to essentially 0 at the start or right during the middle of the housing crisis. And we see that during this time frame, we have really low interest rates from 2009 to about 2015, and we see quite a bit of growth in both of these small cap ETFs. Then we have a rising interest rate environment here from 2015 to about 2019, and guess what? We see growth in the small caps. Then they're kind of flat here at the top of the interest rate market. We see a drop in interest rates again here, right around the time of COVID. And we have a spike in growth, right? So low interest rates do lead to spikes in growth. And then we have a rising interest rate environment here in 2022. And what we see is growth in the underlying index. Now, we still have some more data to look at. We're gonna look at the other indexes as well, but I don't think it's fair to say that small cap ETFs mandated or required to have low interest rates in order to grow. That clearly has not been evidenced over the past 25 years. Do we see more growth when interest rates are falling or are low? Yeah, we do see that, but that doesn't mean growth is not possible without a low interest rate environment. So I still want to incorporate the Russell 2000 here, but I also want to incorporate the S&P 500 here and the NASDAQ 100 here, all going back to June of 2000. And then what I'm going to do here, so we've got the total data right here, and then what we're going to do is we're going to break down some of these individual timeframes to see which of these indexes performed the best. This is just the price per share, but we're going to break it down into a few assumptions here in just a second. So here are all the indexes, and what we see, white line is federal funds rate with this index here, this axis here, excuse me. Purple, S&P 500, red is the Russell 2000, and green is the NASDAQ 100 from June of 2000. Now from here, what we can see is that assuming all the money came in the year 2000, all of them grew, right, obviously, but at the same time, the S&P 500 experienced the most growth compared to the NASDAQ 100, and then the Russell 2000 was much lower. But we'll notice is these trends here, right? We're still seeing a trend that all three indexes are growing during this rising interest rate environment here. There's a drop in interest rates here, and there's a massive amount of growth that occurs during 2009 to 2015 across all the indexes. Yet they also still continue to grow through this rising interest rate environment here. There's a drop here in interest rates coinciding with the COVID-19, and we see a big spike in all three indexes during this low interest rate environment time here. And right here, what we notice is that with this rising interest rate environment, we see very little growth comparatively with the Russell 2000 compared to the other indexes. But let's get a little bit more granular. Let's first look off not just the price per share, but also we're going to look at the actual assumption that we start with $100,000. What we notice here, so in this first time period, we're looking at, again, $100,000 lump sum investment. We're reinvesting all distributions along the way, any dividends from any of the indexes. What we see here is if you had invested all the money in 2000, in June 2000, then the Russell 2000 outperformed the majority of this time frame. And then in the end, though, it gets underperformed just slightly based on the other two indexes. But obviously, most of you guys didn't do a lump sum investment in 2000. So let's look at some more distinct time frames, specifically this time frame here from 2004 to 2006 during a rising interest rate environment. Then right here, this specific time frame where interest rates were artificially, or I guess just low, kept low for a long time. And then another rising interest rate environment right here. So first time frame right here, we can see a rising interest rate environment from 2004 through 2006. What we see here is despite this rising interest rate environment here, the top performer of all the three indexes was actually the Russell 2000. Went from 100 to 125 versus 100 to 121 for the S&P 500 and 100 to 107 for the NASDAQ 100. That's right, essentially in a rising interest rate environment, with the exact opposite of what we would think, the top performer was the Russell 2000. Then we've got the time frame 2009, January through November 2015, where interest rates were essentially, it shows them bouncing around, but really they're bouncing between 0.05 and 0.2, so very low during this time frame. And so during this time frame, we see that the NASDAQ 100 was the top performer, went from 100 to 419, whereas the Russell 2000 was actually in second place, went from 100 to nearly 300, and then the S&P 500, 100 to $288,000. So clearly in a low interest rate environment, all of them do well, particularly the NASDAQ 100. Then we've got this third time frame. Again, this is another rising interest rate environment where the federal funds rate went from really low in the range of 0.12 to a high of 2.4%. And during this time frame, while the NASDAQ 100 outperformed, all three of the indexes made money, from 100 to 137 for the Russell, 100 to 142 for the S&P 500, and 100 to 156 for the NASDAQ 100. So key takeaway here. Do low interest rates result in really strong growth for the small cap? Yeah, absolutely it does. But it's not mandated. It's not required for the small caps to grow. It performs best during that environment, but even in rising interest rate environments, the small cap ETFs actually performed well, and during certain time frames actually outperformed large cap, the NASDAQ 100, the S&P 500. Is market growth correlated with interest rate environments to an extent? Sure it is. More growth with low interest rates. But I think what this data shows is that there's not really a wrong time relative to interest rates to be in the market and growing. If you want access to this spreadsheet and to learn more about all the data that I put into it, make sure to check out the Average Joe Investor Patreon community. There's a link down in the description below. You get access to spreadsheets, access to the DIY investor community. That's part of the Average Joe Investor Patreon community, and access to daily office hours with Joe every weekday at 12:45 Pacific Standard Time. If you're interested, check out the link down in the description below. Also, make sure to leave your 2 cents down in the comments below. That's my goal, to respond to as many of those comments as possible on the day I post a new video. That's all I got for you guys. Have a great rest of your day, and thanks for watching.